Welcome back to another episode of the Pumped On Property Show with Ben and Simon. Today's podcast is a little bit different to the average content that we are bringing to you, where we talk about the coming GFC and how you can prepare for it and how you can capitalize off it as well. This is a topic that Ben and I are really passionate about and love learning about as investors, because we're always looking for a slight edge so that we can become financially free and live a life filled with choices without copping too many bumps and bruises along the way. So I hope you guys enjoy the content. I would highly recommend sticking through for the whole one today, guys, because there is some absolute nuggets of gold, and this will help you prepare for what's to come over the next few years. I think something that we've always been quite good at, or me personally, is kind of like living life with the mentality of the glass is half full. So it's more of an optimistic view of the world. It's an optimistic view of the future. I always think of, best case scenario. And of course we plan for the worst case scenario. And that's why we're bringing this content to everybody today. But, I think a lot of people get quite fearful about these ideas. Oh, GFC is coming. And that does obviously bring up a little bit of fear, a little bit of uncertainty, a little bit of anxiety for investors, because nobody, wants to see their assets decline in value. But if you talk to any sophisticated investor that's lived and invested through many real estate cycles, if you talk to, anybody who understands these opportunities, they explain it as exactly that. Like, this is a once in a lifetime investment opportunity. And if you know how to time it, if you know what to do and when to do it, your life can change forever. And like, a lot of people serendipitously fall into this place. I think you're a prime example of that, as am I. Beginning your investment journey with your first property just as the dust settles after the previous GFC. And for me, I got my investment journey started just prior to the mid-cycle slowdown. So I think that's what I want to kind of talk about today, is like the opportunity, what to do when history repeats itself once again.
I absolutely love that, because it really is about preparing for the next opportunity. And while this will be scary content for some people who it's new for, there's many other people out there that are completely across Phil Anderson, Fred Harrison's, Akil Patel's work. And I think, as a bit of a precursor before we talk about the opportunity and how we're both preparing for it, we should explain what it is.
Yeah, we'll rewind the clock a little bit.
So we won't go into it. Yeah, exactly. Or a couple of hundred years before that even.
Yeah.
So basically, there is a cycle of the movement of money. Regardless of if you believe in real estate cycles or stock market cycles, there is times when money's really, really available and easy to access in the system. And then there's times where it's very difficult to access and there's not a huge amount of finance available. And generally, in times where there's heaps of finance, it's really easy to get, things go nuts, depending on how much fuel they want to chuck on the fire. And in times where it's hard to get money, or there isn't much money circulating around the world, at least from a lending perspective, it contracts and we end up in a recession or a depression. So this 18.6 year cycle is probably best explained in Phil Anderson's book, The Secret Life, Real Estate and Banking, Akil Patel's book, The Secret Wealth Advantage. But both of them came off the back of Fred Harrison's work. So Fred Harrison in 1984 wrote a book called The Power in the Land, predicting the 1989-1990 GFC effectively. He then wrote a book in mid-2000s predicting the 2007-2008 global financial crisis. If you look at what he is saying right now, he's saying late 2027, 2028 is when he is forecasting the next major crash. So this isn't something new. Before his work, he studied 350 years of UK booms and busts, and it was just the observation of a pattern of scarcity and abundance thrown over a period of time that is so long that most people miss it, that created this sort of work.
And even if we go much further back than that, like, all of these guys base a lot of their work off Henry George's work, who, was probably one of the most intelligent economists of all time. He was from Chicago, and he identified this real estate cycle in Chicago back in the 1800s. You see, work from farmers that obviously follow commodity cycles, and it spits out a similar timeline. W.D. Gann, same sort of kind of guy, like thinks really differently to the average person, and identified this cycle way back when, hundreds of years ago. So, this isn't new. This has been around for an extremely long time, but it appears to be just long enough that people forget.
Yeah, that's exactly it. So right about now, there's a whole wave of new investors in the market, but people like George Soros, Warren Buffett, Ray Dalio completely get this stuff, completely understand when to buy and when to sell. And there's the famous Warren Buffett quotes around all of this stuff. But effectively, what it actually means is we're in what's called the winner's curse phase right now. And that is when many, many things are sort of going up at the same time. And we've sort of been in this phase for a little while. And generally it's when the cycle goes over the top. And then the declining phase or the end of cycle recession or depression generally looks a little bit like this. Stock markets, whether it's Australian, European or American, get absolutely smashed. Historically in the last 100 years by as much as 35 to 60% decline. And that decline can last for a while. Like we were looking at the S&P 500 chart. From the high in 2007, it took almost to 2012 to sort of get back to that all-time high, or the high before going into the last crash. In terms of properties in America, they get absolutely belted. So some suburbs fare well, like some markets do well, like 10% declines. Others can go down as much as 35 to 50%. In Australia, according to Phil Anderson, who wrote the book on this stuff, effectively said Sydney and Melbourne's declines are generally about 8%. Brisbane and Perth's declines are generally about 12%. So it's nothing to go freaking out about, because by the time you buy a property, hold a property and sell a property with the tax and agent fees, you're looking at a loss of more than 12% anyway. So it's not like go sell all your properties and freak out and screw all your money. It's just more about the opportunity and how to prepare for that, I think.
Absolutely. And just awareness helps you avoid making mistakes, because, a lot of people kind of speculate at this time of the cycle, and that's what sends it to this next level. And that's where things get a little bit shaky, because people are just speculating. They're not necessarily investing with the fundamentals at bay. So I think about last time in Australia, the mining boom really set off a lot of these small towns with no economic fundamentals into all-time new highs, like ridiculous prices and rents. And then those speculative markets really feel the burn. They really feel the pressure of the end of cycle recession, because there's no economic diversity, there's no fundamentals to keep the market propped up. But then when you look into markets like Melbourne, Sydney, Brisbane in Australia, they do remain relatively unscathed in comparison to these small towns, because there's the people there, and people are still going to be working, people are still going to be earning, people are still going to be spending. So there is a flaw underneath those big capital cities, because obviously, there's so much propping the markets up.
And I think that's important, because you and I have spoken to more than 5,000 people each, and there would be at least a couple of hundred stories that we've heard from the last GFC where people got really burnt. So a few of the stories that I think are just examples of how bad it can go if you're not structured to take advantage of the opportunity, or if you're not structured to take advantage of the opportunity, at least protect yourself and your family from the downside risk. One of them is the properties that are on Noosa Waters now that are selling for $5 million today. In the last GFC, were selling for 600 grand. Now in 2007, they were sitting at about 3 mil. And then there's a lot of holiday makers up in Queensland. There's unlimited amounts of holiday homes.
Last summer, like in the summer of 24-25, me and some friends hired a barbecue boat on the Noosa River. We're cruising through the canals, and honestly, 1 out of every 3 houses was a vacant holiday home.
100%.
And that's because we're at the end of cycle. We've had a 14-year growth run, 13-year growth run, and people, have a lot of extra money to spend at this time. And when people have all of this extra money to spend, they buy emotional things. They get the nice new car on a lease. They get the nice new caravan, the nice new jet ski, the nice new boat, or the nice new house if you're doing extremely well. Like, these houses are $3-4 million houses on Noosa Waters. Like, they're not spare change assets. Like, they are very expensive, and it's just incredible to see that. But obviously that's a non-income producing asset. It's something that people use when times are great because they've got access to holidays, whatever it might be. But when times get tough and interest rates go back up and you have zero occupancy in these properties, then what's the first thing that you're going to sell? It's the non-income producing asset.
That's right. The scenario can be, well, business is great or income is great, and then things start going south. And it's not like the mid-cycle slowdown, like the COVID environment, where it gets tough for a little while and then it immediately props itself back. It's like there's a bleed that we'll talk about in a moment. But those 1 in 3 properties in Noosa were sold as mortgagee in possession, which is effectively the bank taking ownership and selling it. And because there's no access to finance and people are scared, they sell for basement prices.
And another example of this is, these mining towns. So I guess an example of this is Gladstone, because I've talked to, unfortunately, too many people that got burnt by this last time around. And, in sort of, it lasted a bit longer in these regional towns because the mining sector was continuing to boom in Australia up until around about 2011. And then, people would buy a house in Gladstone at that point in time for about $600,000. And they thought it was a bargain because the rent return was like $850 a week on that. Back in, the 2010s. Like, that's insane. Property prices are barely even up at that price today. And that's after a full cycle. And vacancy rates were super low, below 1%, because the mining sector was booming. There was an abundance of jobs. There was an abundance of money. Everybody was killing it. Then, the recession gets to the mining sector, and everybody that was employed by the mine gets sacked. They move away from Gladstone, back to Brisbane, back to Sydney, back to Melbourne, back to Adelaide, back to Perth. And so vacancy rates spike. And then people are forced to sell their properties that they bought at 600,000. The next best offer is coming in at 300 grand. You've taken 100% bath. But the alternative is holding on to that property with no rental income, that you're in a negative equity situation. And it's just really, really tough to see, and really, really hard to hear those stories, because nobody wants to, lose their money. Everybody works their freaking ass off, and everybody is trying to make the most educated decision with the information that they have. But unfortunately, people aren't privy to this information. And that's why we try and bring it to you, so that you can avoid those speculative bad investments, and you can avoid making those emotional purchases like the holiday home, and you can just focus on what is going to be the best thing to keep you safe over these years.
I love that. Like, the last story is one of the agents that I know that sold a couple of properties for me. Business was booming going into those later years of the cycle last time, 2005, 2007, 2008. She'd bought this beautiful property on Oceanic Drive, which is one of the nicest streets in the Sunshine Coast on the southern side. It's right on the beach, and she paid 1.8 mil. She ended up selling it because her business income wasn't coming in anymore, and she sold it for like $800,000. And that was within about a period of 12 months. Like, she expected the show to go on, and at some point the music does stop. And so it's important to know that each cycle, like last time it was very mining speculative driven, and mining towns, like, I still remember it. Like, it was absolutely nuts the way that people were feeling about these towns. There were places where you could buy something for 300K that was renting for $1,000 a week, and that went up to like 900 grand. Like, whoa, in 18 months, like, people everywhere were just talking about this stuff. And this time around, so every cycle, there's something that sort of takes speculation over the edge. And so something that I was reading from Phil a couple of weeks ago is the real economy is now quite flat. And you and I were talking about this off camera, just how hard the average person or a person that's earning between 100 and 200K per year in Sydney, Melbourne, and Brisbane is doing it right now. And so there's this real economy of like, it's just hard. Interest rates are high, expenses are high, there's not enough money at the end of the month, rents are high. And then there's the speculative economy. So last time it was gold mining companies and mining towns. This time it is AI stocks. If you look at the breakout on AI stocks
Crypto.
versus the real thing, and then absolutely crypto. And that's completely cool. Like that's how it is.
Every time it changes as well, and that's why, people don't necessarily believe in these things. And look, we're still cautious skeptics that follow it so closely because I'm intrigued, curious to see if it's actually going to happen again. And all signs are showing that yes, something is going to happen again. But because it's always something different that leads the big boom at the end, and then that causes the big crash at the end. So last time it was obviously the mortgage-backed loans in mortgage-backed bonds in the United States. A great movie to watch to learn more about, what happens at that time is what's it called again?
The Big Short.
The Big Short, that's right. Great movie to watch to see what happens. So that's what caused it last time. But prior to that, in the late 80s, early 90s, the big crash was like touted as Black Friday. But, it was driven from mass speculation during the entire 80s, which was one of the strongest decades that we've seen in recorded history outside of maybe the 1920s.
And those rates went up at that time, as my parents had told us, to the point where they were paying 17 to 19%.
Yeah.
I remember them saying they had a deposit ready to buy a property, and the home that they wanted to buy went from 60K to like 120 or 140K in like 9 months, and they couldn't save fast enough. So things happen each time, but one of the greatest quotes in that book is, "There's nothing new under the sun." And so remembering that as we go through this next phase, it's going to get more speculative and more showy, and many, many more people are going to make a lot of easy money before we hit the top, particularly around Bitcoins or different commodities. Like, it's the time for gold and silver to start going off as well. Gold's already gone up 45% a year for the last 2 years. And things like AI stocks, like, some of the most valuable companies in the world are going to be tied to this stuff now. And you can chase it, but just know that there is a limit to it, and then the market is clever and it revalues things correctly over time.
And the why this is here is, such a complex question to unpack, and probably we don't have the expertise to be able to kind of explain it. But, essentially, there's another really good book that you can read, The Creature from Jekyll Island, by G. Howard Griffin, who talks about how money is created, and essentially educating us on the fact that the whole entire system is built on debt. And he believes it's pretty hectic, and he believes that it's, all corrupt in some way, shape or form. Like, it's designed to keep people working, to keep people paying these big corporations and organizations, to keep people paying tax for longer, to keep people working essentially. And
they need people to be working for 30 to 45 years. And like, the system is they talk about it in the book, 100% designed for that reason, because there is always a younger and older population, as well as infrastructure that needs to be created. And you need people like you and I that are doing the work, paying the taxes to keep the show on the road.
And also to pay for the aging population and the younger populations and the less fortunate people as well. So it's all built on debt, and it's all designed in a way to keep us working. But what was fascinating, and something that Phil talks about basically any time you hear him open his mouth, is the idea that it was written out of the economic textbooks. And he talks about Henry George a lot with this stuff, where Henry George came with a solution to the problem, because these booms and busts have been occurring for centuries. He was like, how can we fix the problem? And he created a way to solve the problem essentially through a land tax, but it got smeared. People just put Henry George down, told he was a kook, told he was, pseudo-economist, and, all of that information just got disregarded essentially. And it's because, whilst they don't take land values into consideration, essentially the land is going to continue to capture all the economic benefits in society. And because we're built on debt and because you can speculate on land values, it's essentially going to be a permanent boom bust cycle so long as we operate under this capitalist system, unless some major changes were to occur. But the powers that be won't allow any of those changes to actually come into effect.
And so over this longer term cycle, right, there's the middle point.
If Henry George were to hear that, he'd probably be like, fuck, you got it so wrong, Simon.
Yeah, probably, yeah, 100%. But that's fine.
So don't quote me on that, please.
Yeah, like he, can't say anything about it because he died a long time ago. But yeah, like he was very disruptive for a period of time, and then like the system does what the system does to that sort of stuff. But effectively the big difference between the mid-cycle slowdown, which is it's been called COVID, it's been called 9/11 or the dot-com boom bust, it's been called the recession we had to have, it's also been the Cuban Missile Crisis. Generally what happens is something scares the world in the middle of the cycle. Things have been going up a bit and they go, oh, it's getting a bit bubbly. And it was in Australia. Like property in Sydney and Melbourne were going ballistic by 2015 through to 2018. And to the point where the Australian government had to step in and go, enough's enough. And slow the entire like property market speculation thing down.
Because there was a lot of memory of the GFC. It wasn't that far after, essentially. It's sort of like 7 to 8 years later.
Yeah.
So there's a lot of people that are still in power or in high positions in banks or APRA or whoever it was that remembers. And they're like, hey guys, like, remember when we did this last time? You've got to take the pressure off.
Let's pump the brakes. And so what happens is we pump the brakes. They let less cash into the system for a period of time. The stock market goes down, property markets go down, sentiment goes way down. And then they go, oh, this isn't quite as bad. Maybe if we inject some more money into the economy, reduce the interest rates, drop some helicopter money on some people who will spend it, gives people some tax breaks or some first home buyers grants. And then we build a shitload of infrastructure, it'll keep the show on the road. And they go, oh, it worked at this point.
Little do they know is they've poured a whole can of gasoline onto the fire and just thrown a match into it.
Yeah, like when you give the amount of money that they printed and gave away around the world during COVID into the market, at some point that is going to, like they always say in the books, like it's going to end up in house prices, commodity prices, stock prices, around the world. And it has, and that's why all the assets blow up. So they get us through and they go, that's not too bad. But the governments around the world get themselves in pretty significant debt at that time to sort of bail us out. We go through the next phase, everything feels good. Like it's like, oh, we survived that. That wasn't too bad. And we get to this point that we're getting closer to now, which is like, this feels okay. And then it starts feeling a bit off, which is what we talked about before. And it's like when the average person in Sydney earning 200K can't have a quality of life and can't move forward, there's a problem in the system. There's a problem with incomes versus expenses that comes up at the end. The problem we have now is banks around the world are heavily indebted and governments around the world are heavily indebted. And so things start getting bad. And in the last lead up to the GFC in Australia, I think it was 22 or 26 times they put interest rates up in 18 months to go shit, slow down. But it's too much at that point. And this is where you start seeing institutions like Greece going broke. You see countries like Italy that are still destroyed. Ireland getting absolutely destroyed, Iceland as well. And then on top of that, you see the biggest banking institutions of all time start going under.
There's so many back then that really, really, really struggled. And what Phil and Akil say is like the kind of triggering point, and I actually looked at these the other day, is the first sort of signs of these things starting to fall off the edge is the real estate investment trust, because it's all driven by the land values. And because these REITs, real estate investment trusts, have got so much exposure to land values, when they start to decline in value, that sort of has historically been the first sign that land values are dropping and the economy is cracking.
And yeah, like, you know, the number of building starts. So building starts normally peak about 18 months before the top. And there's other things they talk about too, like
World's
tall
tallest
buildings.
buildings.
They talk about the yield curve, which is the difference between 12-month and 10-year bonds, and an inversion point. And every time that inverts within 18 months, we've been in a GFC, not a GFC,
A recession.
a recession-y type thing, or a lower economic environment. But what happens at the top, and the difference between the middle and the top, is we can see we're going into the crash, but we have to keep the show on the road. And then when the crash comes, it's like, shit, the government can't pull it up because it's run out of cash. The banks can't pull out because other banks are saying, well, where's my money? And the loans are expiring and the things are starting to happen the same as they did in the Big Short. And then we get to a point where it's like, they have to choose to let it burn for a while and to go down without intervention to reset the value of assets around the world and to reset the market. And then the banks in the background are just clearing as much debt as they can possibly get off their books and the bad assets away. And that can honestly take a period of 2 to even 4 years. Like, it can be a deep burn. And that's what catches most people out. It's not like COVID, which was like, this is horrible. And I know a lot of people suffered for years, but for most people, it was about 9 months. This can be like a deeper burn, and it can eat away your savings when the rates go up. The money isn't coming, the bailout isn't coming, and the system isn't turning itself around straight away. And that's where you need to start preparing for it today.
Another great movie that shows you that is Margin Call, and it looks at a big hedge fund in 2007, 2008. They had some internal analysts that figured out the same thing that Michael Burry found out in The Big Short, which was that these mortgage-backed loans are built on shit and they're all going to fail. And they have a decision point. And the decision point is, do we save ourselves and let the rest of the world suffer and the average mum and dad investor, the average punter suffer? Or do we suffer with everybody else? It just shows you the way that these organisations make decisions and how they think and what their incentives are.
They make decisions for their shareholders, who they're legally obliged to make decisions for,
And
at the expense of average mums and dads like you and I.
and this will even show they don't give a rat's about their shareholders, just the board members.
Yeah.
It's less than that even. So it's like, as long as my money doesn't go down, that's all good. So it's really brutal and sad, but, you know, how do we prepare for that? And you know, what has history suggested occurs during this, you know, end of cycle recession?
You know, so things that Phil Anderson, Akil, would be saying in the emails that we get, and for anyone that wants to like understand this stuff more, check out Property Share Market Economics. You can actually subscribe to their free newsletter, and it's very helpful. 18 months before the mid-cycle slowdown or COVID, they said this month, this year. Like, that's how prescriptive it was. Right now, they're getting very, very clear about similar stuff. So it's very much worthwhile going straight to the source and the experts, not the secondhand info like me. But in terms of my personal preparation, start putting away a little bit of extra cash if you can afford to. This isn't for everyone, because we know that time in the market is significantly better than timing it. But I had a pretty big cycle, lot of assets, lot of accumulation. And so recently I've sold 3 properties. I'm about to sell a 4th. Just getting ready personally. My investment strategy for that time, or actually my hedge against that time, is I've just reset all of my loans to interest only 30-year terms. I've just put offset accounts against every single property. I'm reducing some of the expenses in my life that don't need to be there. Just the simple little things, like if I'm on Telstra for $100 a month, I can be on Audi on the same network for 19 a month. Like, just those little ways, instead of having 7 streaming platforms like my wife loves to have 2. Just those little bits and pieces to start stacking away a bit of extra cash. But then the big one is just recognizing the opportunity that's coming. So who doesn't want to buy Noosa for 600K instead of 5 mil? Who doesn't want to buy a stock like Disney or Amazon or Apple, because the entire market goes down? And just look at the last GFC, a stock like CBA, or the mid-cycle slowdown around COVID. What happens to CBA? Like, even though that particular company might not be leveraged the same way in the current market, the doom just captures everyone. So if you can buy something amazing like that for cents in the dollar, or if you can just get the index and hold it, that's a really big option as well. And then if you look at the gold and silver charts in the 2 years leading into these types of crashes and the first 2 to 3 years of them, they do phenomenally well, like hundreds of percent.
Because people revert to safety, and, you know, safety is, you know, land, owning good quality land in good quality locations. And we'll talk about which markets in Australia fare well, and obviously gold and silver, because, you know, that's such a scarce resource and it's what people value so much. It's been traded forever. So they obviously, like when everybody's losing money in Bitcoin or in Nvidia stocks or whatever it might be, you know, they're going to get the hell away from those volatile stocks and go into what they perceive to be safer, because at the end of the day, life goes on. It is a short period in the grand scheme of things of some really tough times, but if you have the right perspective and you understand the context, then you can obviously succeed and win through this time. So I'm doing a lot of similar things. Like I went very heavy in this second half of the real estate cycle.
With loading up on new assets in your own home.
Let's call it what it is, loading up on debt.
Yeah.
Because that's what I did. I got loans from the bank and bought good quality assets. And now I'm at a stage of life where, you know, the assets have performed quite well, you know, on a single income with a young family and planning to expand that family as well. So, you know, my situation is very different to a lot of people, or very relatable and similar to a lot of people. So for me, it's like reducing my debt position, increasing my income any way, shape or form, like what you said. So going on to interest only variable loans, you know, setting up offset accounts. So any spare cash I can sit against those loans. You know,
You are selling property at the moment as
selling
well. Like
property.
You sold one last year and
Sold
you've
one
got
last
another
year.
one that's up for sale now. Any bites, by the way?
Yeah, a few bites, not where I want it to be though.
Oh, that's exciting.
Close to though, like we're about 15 grand off. So it's real close.
Sheesh.
Yeah,
That's
right
awesome,
there.
bro.
Now it's a new financial year. I think I'll just be patient and wait for the money that I want.
Sure.
And then I'll sell another one at the end of next year. And this is all just to eliminate debt, but also offload the assets that I have done really well from and necessarily don't value as much as I once did. Because as investors, you start with what you can afford. And, you know, that's generally not what you would love to buy. But then you also want to increase the quality of the assets that you're holding.
Yeah.
And so I want to get into, you know, get out of certain suburbs in Brisbane to get into certain suburbs of Melbourne, because I perceive Melbourne to be the superior market with more people that live there, more economic diversity, a, you know, very strong track record of historic performance. So, you know, my goal is to increase the quality of my assets as I go through my investment journey. But there'll be this period of time where I'm going to stack lots of cash, and most people like, you know, as investors, how do you hold on to cash? And it's like, well, the intention is to go hard into these stocks when they do drop. And I'm not going to be picking the individual ones. I'll definitely be going into some form of index, and I'll be paying for the advice from Phil Anderson and Akhil Patel to make sure that I'm aware of the most valuable opportunities out there. So just, you know, rather than thinking that I know this well enough, leaning on the people that know it better than anybody in the world. But I've also got a novated lease. So paying out the car debt and just making sure that that's extra income coming in, getting rid of all the dumb subscriptions as well. I can absolutely relate and I love it. But at the same time, you know, I can do it right now, but maybe in a few years I'll have to pinch those pennies a little bit. Plus, we've also got the opportunity for my wife to go back to work if she wants to, and if we need her to as well.
Yeah.
So there's lots of ways that we can increase, you know, that. And also I can come back to work and start working 5 or 6 days per week if I need to increase my income as well. So there's always ways to reduce your expenses and increase your income. There's a funny video from Jack Henderson that talks about, you know, the cost of living crisis. And he doesn't call it a cost of living crisis. He calls it a cost of spending crisis. And I think it's pretty funny.
Yeah.
And
That's true. Because 100%. Like,
And
I've
it's-
got that in my household right now.
I was talking to Josh Davo, and I'm like, hey man, like, how's things with the family? He's like, bro, I can't leave the house with the kids without spending $100 at least.
Yeah.
And it's like, that's the thing. It's like everything is more expensive, yes, but we spend so much more money. Like, I like to get my car washed. Sometimes I get a guy to come around and mow the lawns. Like, we're on a single income at the moment. We could have a dual income. We've got 4 or 5 different subscriptions, Spotify, YouTube, Netflix, like HBO Max. Like, we've got all of these different things that we can tidy up. But it's like, I understand this cycle. I understand these periods of blissfulness, let's just call it that.
Yeah.
But then I also understand that, times will change. And when those times change, expect your lifestyle to shift a bit. And that's okay.
And I think, I've been watching a lot of sport docos at the moment. And so a lot of the way that I'm thinking about things goes back to that. And I think there is a time for pre-season where like these pro athletes get eat really well. They put on size that's going to carry them through the season and muscle to protect their bodies.
They also rest.
They completely rest. They enjoy themselves. But pre-season is not off-season. Pre-season is a period of extremely focused work. And I think if you think about the GFC style environment, that is the time of pre-season in a lifetime where you have to go a bit harder than normal. And then there's a 7 years up, which is a beautiful period. There's still a living memory for most people. It's like, that sucked. That was really hard. You'll hear many people, unfortunately, will lose their houses during this time, their cars, their jobs. Like I remember working at IBM at the time. We went from 400,000 people in 2011 to 180, maybe 200,000 by the end of it.
You stuck around.
I somehow...
Your $40,000 a year salary stayed around.
I was lucky to keep my head and my job.
Hey, we need someone to buy us coffees.
Exactly. They needed someone to photocopy stuff. But,
I'm just joking, bro.
That's exactly what I really was doing, which is why I left.
100%. Waste of time.
Yeah, but I think it can be very, very, very real. And so you don't want to be in that point at that time where, as you said, you've got the multiple novated leases, the credit cards with the high interest rates, the low fixed interest rate that's about to roll over, the interest-only home loan, because they'll get to a time in the next 3 years where your interest-only home loan will go to P&I, but the banks will not let you go interest-only again. And that's the big reason I just gave myself another 5 years, because I can do it today while they're open to it. You think they're your friends until they're absolutely not. And so I just think being protective and being aware, but then as you said, like just recognizing that it's a once in a 20-year opportunity. This will be my last monster opportunity at the stage of life that I'm at, because the next time this comes through, I'll be 60. Like that sounds crazy.
Yeah.
For you, you'll have 2 more of these. But for a lot of people, especially those like me in their 30s, 40s, and 50s, this is the chance to double, quadruple your money and protect your downside too. If you're sitting on, like our mum, for example, based on the advice of Phil, when we went into the mid-cycle slowdown, she had like, I don't know, 600 odd K or something like that. I can't remember what she had in super, maybe a bit less. And I said to her, like, I've heard this. I don't know if it's going to happen or not. He said, go into cash. She went into cash. She missed the decline, and then she bought when it was cheap and did really well out of it.
Now she's back in cash. So's Dad as well.
Yeah.
And anybody that's close to us that's willing to actually listen, is doing safe things with their super, because if you are in your 50s or 60s, you do not have the opportunity to lose 50% of your super right now.
Well, part of the big country sea change during COVID was the fact that that was the time that finally super from the last GFC got back to where it was before. So it pushed the retirement age back for people by 10 years. Like there were so many people that just went, I can't afford to because I've lost half my money. I've got to wait. And then that was why so many people went to Tassie, Sunny Coast, Gold Coast, then the beautiful markets around Oz.
But let's, talk about the opportunities. So we've, I think you stumbled across Phil's work back in 2017, maybe.
Yeah.
I think we went to our first seminar of his in 2018.
Yeah.
I think we've been to 3 or 4 since then. I know you communicate with him via email, over the phone regularly.
Just bug him.
Yeah, here's his pest again. I think you've sold a fair few of his books, so I'm sure he'd be grateful.
Yeah.
And so, we're not just punters that have read these books and, tried to analyze it ourselves, it's like we actively lean on, I lean on Darren a lot, one of his colleagues, and, unfortunately we don't have that relationship with Akil yet. Akil, hit us up. We'd love to build that relationship. But like we try and understand this as much as we can, because whether it's real or not, like taking in interesting ideas and interesting information is really important. But in one of these seminars, we looked at the average declines. So in Australia, as you mentioned, Sydney, Melbourne around about 8%, Brisbane, Perth around 12%.
Property price declines, yeah.
Property price declines average. And then stock market was roughly between sort of a 50 to 60% decline. Some stocks will be burnt even worse than that. Some crypto coins will go to zero. And so just being cautious. But then once the cycle restarts, which is generally 4 years after the peak, so we say the last one was 2008, the technical beginning was 2012, even though there was some property markets that cranked over that period of time. Like Melbourne from 2007 to 2011 went up 44%. So over 10% per year over that 4 year period. But then the average property in Australia from, essentially the beginning of the new cycle until the peak, that 14-year growth run that split into two halves, they go up by about 120%. And then the S&P or was it the ASX that you figured out goes up about 240% over that 14-year growth period?
Yeah, like they can do extremely, extremely well. And some of these markets can do a lot better than what you just said as well. But I'm not an individual stock picker. I'm just an
average guy,
an average index guy.
And that's why we also invest in your Brisbanes and your Sydneys and your Melbournes, because we're looking for the averages that are going to consistently give us a return. Not really interested in these speculative ones that are going to boom and then bust real quick.
And so my thought process is I am an investor. I've just pulled some money out of my super and gone self-managed. When we look at over 4,000 suburbs across Australia, across about 15 indicators in each suburb, we can see value in markets around Australia right now. Melbourne looks fantastic in the last 8 years. Like there's suburbs in Melbourne that have literally done 3 to 5% a year for the last 8 years, where historically they've done over 9.5% a year according to Homely. Darwin looks phenomenal too. Like it's done less than 2% a year for the last 10 years. Parts of Brisbane look fantastic too, especially with the Olympic Games coming. And when I did ask Phil, well, what's the story with Brisbane and the cycle? He said because of the jobs, the income growth and the infrastructure coming, Brisbane might fare better than it normally would during this time. But other parts of Brisbane have already tripled in the last 15 years as well. So I'd recommend as an investor that time in the market is significantly better than trying to time it. Some of these suburbs we're buying at the moment are going up by 10 to 25k a month. The thought of buying something for $1 million and making 20% on it, so 200k, to lose 100 grand of it for a period of time is something that I can stomach. And so I'm buying property with my super, but it's just not a time to go over leverage. It's not a time to be doing 105% loans. It's not a time to be using heaps of trust structures and getting all of these fake,
benefits, whatever you want to call it.
Yeah, like cash flow properties that your broker's dodged up and now you've got 6 of them like the strippers in The Big Short and you're going to lose it all when the interest rates go up and 3 of the properties are empty for a period of time. It's not a time where you want to be speculating in random marketplaces. It's not a time when you want to be buying off the plan units or really expensive fringes of cities, land, and building something monstrous on it. It's not a time where you want to be overshooting yourself. So who is the right person to be buying at the moment? People in safe positions, with good incomes, in steady careers, with great cash flow.
First home buyers, first time investors that are going to be investing. Anybody that's between the ages of 18 and 40 that's going to hold the property for the next full cycle.
Yeah, like people with a long-term view of 15 years plus, people that aren't trying to speculate. So it's a deadly point in the cycle to speculate right now. If you already owned assets and you're completing them now, like we both have, 100% sweet.
Yeah.
If you're starting projects now, like, just know that the market can turn and there might not be those buyers sitting out there for you in the future to just immediately sell to, and you might get stuck holding the asset.
You know, I think something that I hear a lot of the time is I love it and I love the ambition that people have. And it's like, you know, I've stumbled across investing and I'm really passionate about it and I want to make up for lost time. So I'm going to, you know, leverage myself to the hills, 95% loans. I'm going to buy a property every single year. I'm going to do whatever it takes to buy these investment properties. So, you know, understanding that it's okay to be ambitious and it's okay to have some, you know, really massive goals that you want to achieve and you really want to work hard on achieving. But also understanding there is some external influences that are going to impact your decisions. And sometimes that's not actually realistic or achievable. And we've always talked about it, you know, 10, 20% deposits, the more cash that you can put down, the better. Making sure that you've always got a buffer. So like, you know, for me, I want to make sure that I've got at least a 9-month cash buffer to hold every single one of my assets during a bad time with absolutely zero income. So things get really tough and vacancy rates go up and interest rates go up. And, you know, I want to make sure that I've got enough of a buffer there to hold through the really, really tough times. Because when I look back at the data in Australia, there was 1 year, 2010, where like property values dropped pretty hard in Melbourne, in Sydney, in Brisbane, in Perth. And that was like the real bad year. But, you know, 2007, 8, 9 were great in Melbourne, Brisbane and Perth. 2011 and 12 were really, really strong in Melbourne and Perth. So, you know, it was really only one bad year. And it's like the worst thing that you can do is sell in that really bad year. So making sure you've got these cash buffers in place so that, you know, if your property is unoccupied for a while or if your interest rates go up, you've got the cash available to be able to hold those properties through the really challenging months.
I think when I first came across this information, it really frightened me, to be honest, because I didn't understand it. And as I've read the books, as I've talked to the authors, as I've read their emails, as I've studied charts and history, I've gotten more comfortable with the fact that it's like everything in life. The tide goes out, the tide goes in. Like there's day and there's night. And there are hard times and there are easy times in an economic cycle. And some of these opportunities can be the biggest of a lifetime. They can, but this time could potentially, for a lot of people listening to this, be a once in a lifetime opportunity to do extremely well. For other people listening to this, it's going to really hurt. And it's just thinking about, well, if I don't have a plan B, plan C, what could those look like? And just the cool thing is you're hearing this early. Like this is early. Like it's not here right now. We've still got time to go through some things. Some markets are still going to do extremely well. And some markets will thrive through this as well. And that's the important thing to remember, because there's still 500,000 people coming into the country a year. The banks are still willing to give out credit right now.
We're in an interest rate declining cycle that should last at least 12 months, but could be up to 24 months.
Yeah, like they're pulling the interest rates down at the moment so they can bump them.
Artificially spike the economy.
But I'm glad they're doing that now versus doing it like the year of, and it's too late and it's not going to have an effect. So, you know, it's all part of a longer term cycle, and I'm grateful that I know it, and I'm grateful that we could share this with everyone today. And we wish you all the best through this coming period, everyone listening to this, so that you can, you know, survive it, but also thrive through it as well and set your families up for life. G'day guys, my name's Ben and I'm the director here at Pumped on Property. And I just want to say a massive thank you for watching our content today. Now, if you're thinking about buying an investment property in the next 3 to 12 months, then the team and I would love to offer you a one-on-one strategy session. In that session, we can talk about exactly where you are right now, where you'd like to be longer term, and we can deeply educate you on the Australian market. And then you can take that information and go and absolutely smash it on your own, or potentially become one of the small number of clients that we work with each week. To book your session, all you have to do is go to www.pumpedonproperty.com and click that book your free strategy session button. But either way, we wish you all the best on your journey as an investor to financial freedom.